Hello, this is Japanese Economic Review Channel. This time, let's take a look at SBI Securities' domestic weekly outlook.
Thank you. It is quite a week we have ahead of us.
It really is. I mean, if you've been sitting at your terminal lately, tracking the ticker, you know exactly why we need to unpack this massive stack of data from SBI. We're going to sift through this with a fine-tooth comb today.
Yeah, you really can't afford to blink in this market environment.
Exactly. So to give you a clear roadmap of where we're heading in this deep dive, we've broken it down into three distinct parts. First, we'll cover this week's stock outlook, which means dissecting that really severe drawdown in the Nikkei and figuring out where it's heading next.
Right.
Then we'll pivot to part two, key factors and FX. We're going to look under the hood of the USDJPY and the absolute roller coaster it's been on.
Driven by some intense geopolitical forces.
Exactly. And finally, part three will be the weekly timetable. We'll walk you through a day-by-day breakdown of the critical market events from March 9th to March 13th.
And if there's a hook to this entire week, it's really about whiplash. It's about how incredibly fast a market can pivot from this sort of risk-on optimism to outright risk-off panic, basically based on a single headline out of the Middle East.
Yeah, let's get straight into that, starting with Section 1, this week's stock outlook. Because, frankly, the numbers from last week were brutal. We need a bit of a post-mortem here.
We do. The reality of the tape was ugly.
Ugly is an understatement. The Nikkei 225 took a massive hit. It dropped 3,229.43 points.
Over 3,000 points. Just wow.
Closing at 55,620.84. And the TOPIX wasn't spared either. It tumbled by 221.75 points to close at 3,716.93.
Yeah.
And if you were trading intraday on the 4th, I mean, it was vertigo-inducing. The Nikkei plunged all the way down to 53,618 yen at its lowest.
Which is just a staggering velocity for a sell-off.
It's like, think of it like cruising down a newly paved highway. You've got the top down, you're expecting smooth sailing because, well, everyone is anticipating lower U.S. interest rates, right? The conditions seem perfect. And then out of nowhere, you just have to slam on the brakes with both feet.
That's a great analogy. Because you're driving based on the macroeconomic map, but the obstacle that suddenly appears on the road is entirely geopolitical.
Right. So walk us through the why here. What actually caused that brake slamming moment?
The catalyst was Iran's attack on Israel. That news hit the wires and instantly triggered a sudden, severe risk-off sentiment.
Because algorithms don't wait to read the nuance of an article?
No, they don't. They scrape the keywords attack, conflict, Iran, Israel, and they execute. Capital aggressively flees equities. And the broader point here is that markets fundamentally hate uncertainty.
An armed conflict is basically the ultimate uncertainty.
Exactly. You can model earnings, you can model rate cuts, but you cannot model the escalation of a kinetic war. So traders pull their bids, liquidity dries up, and the floor just drops out.
So given that trauma, what does this all mean for this week? Are we going to see a bounce back or more pain?
According to the SBI Outlook, we are entering what they call a box, or a range-bound state.
Okay. What are the numbers on that box?
They're projecting the Nikkei to fluctuate between 54,500 and 56,500 yen.
So a 2,000-point channel. That feels a bit like the market is just holding its breath.
That is precisely what it's doing. Investors are sitting on their hands right now. The initial shock has been priced in, but nobody wants to deploy major capital until they get a look at the upcoming U.S. employment report. They need to know the U.S. economic engine is still running.
Now, there's a wild card in the SBI report that I want to bring up. It's a crucial detail.
The oil markets.
Yes, NY crude oil futures. We are seeing them creep up toward that $90 a barrel mark. Why does that specific number matter so much to a Japanese equity trader?
Because if oil spikes to $90 and holds there, it is the worst possible timing. It threatens to reignite inflation fears globally.
Which means the U.S. Federal Reserve can't cut interest rates like everyone wants them to.
Exactly. And for Japan, which imports almost all of its energy, it is devastating. It squeezes corporate margins, meaning less profit for these companies on the Nikkei, and it triggers further downside in the stock market.
Which actually provides a perfect bridge into Section 2 of our deep dive today, key factors and FX.
Yeah, because energy costs and the yen are inextricably linked.
Let's look at the playing field for the USDJPY this week. The SBI report projects a range between 154.20 and 160.000 yen.
That is a very wide playing field.
It is. And to understand why it's so wide, we have to look at the daily roller coaster from last week. Let me walk you through this whiplash.
Please do.
Okay, so Monday, we get hopes for a truce from a Hamas official. The geopolitical tension eases slightly, so the safe haven dollar is sold off and the yen actually strengthens.
A logical market reaction.
Right. But then you wake up Tuesday, media reports hit that Hamas rejected the truce. Boom, the dollar shoots right back up.
The risk premium is back.
Exactly. Then Thursday arrives, and it's just a confusing tug of war. Reports emerge that Hamas hasn't left the negotiating table.
But simultaneously, we get reports of clashes between Israel and Iran.
Right, so the market is being pulled in two different directions at the exact same time. The dollar ends up ending the day just slightly up, but it was a chaotic session.
What's fascinating here is how hypersensitive the currency markets are right now.
Right.
It is not just about economics anymore. It's not just about yield curves. Traders, and specifically automated trading algorithms, are trading on geopolitical headlines minute by minute.
So how do you even chart that? If everything is headline-driven, do technicals even matter?
They do, because they provide the boundaries of the panic. Let's break down the technical support SBI points out. On the top side, 160 yen acts as a very heavy psychological ceiling.
Because everyone is terrified the Japanese government will intervene and buy yen if it crosses 160.
Exactly. Nobody wants to be holding long dollar positions if the Ministry of Finance suddenly steps in. So 160 is a heavy, heavy roof.
And on the downside,
The 154.20 mark, that represents the 26-week moving average. That is a critical support floor. If it breaks below that, technical traders will start shorting it heavily. So we are trapped, bouncing between this 154.20 floor and the 160 ceiling.
and waiting for what? What breaks us out of that range?
Well, both of us know the market is waiting for the U.S. economic indicators. Employment, CPI, PCE, those are the things that will dictate the next major structural move in the FX market.
Which brings us to the most dense part of our analysis, Section 3, the weekly timetable.
Yeah, grab a notebook for this part.
Seriously, this week, running from March 9th to March 13th, is incredibly busy. We are going to walk through this SBI table day by day. Let's start with Monday, March 9th.
Okay.
We've got Japan's January current account, from the U.S., the January wholesale inventories, and the NY Fed consumer expectations. But the big one on Monday is China's February CPI and PPI.
Yeah, that is the heavyweight for Monday. China's inflation data sets the tone for global demand right out of the gate. Well, if China's producer prices are falling, it means they are exporting deflation to the rest of the world. That actually helps lower inflation in places like the U.S. But if their prices are rising, it shows their internal demand is recovering, which changes the global inflation calculus immediately.
Okay, so that sets the stage Monday. Then Tuesday, March 10th, Japan releases its revised October-December GDP and bank lending figures.
Always important to see if the domestic economy is expanding or contracting.
Right. And from the U.S., we get the federal budget and small business optimism. But there's also a U.S. 3-year Treasury note auction. Now, an option doesn't always make headline news, but it's a critical temperature check, isn't it?
It absolutely is. It's a temperature check on U.S. debt demand.
Hmm.
The 3-year note is particularly sensitive to what the market thinks the Federal Reserve will do with interest rates over the next few years.
So if the auction goes poorly, meaning investors don't want to buy the debt unless they get a higher yield, that pushes U.S. interest rates up.
Exactly. And when U.S. interest rates go up, the dollar gets stronger, pushing the USD-JPY pair right back toward that dangerous 160 yen ceiling.
That makes perfect sense. Okay, Wednesday, March 11th. Before we get to the data, we should note that this is the 15th anniversary of the Great East Japan earthquake. It's a somber moment of reflection for everyone in the country.
Yes, absolutely.
On the economic data front for Wednesday, Japan releases the Corporate Goods Price Index. And from the U.S., we get the February CPI, the Consumer Price Index, and real earnings.
I'm going to zero in right on the U.S. CPI.
I figured you would. It's the big one.
It really is. If inflation in the U.S. runs hot, if the CPI comes in higher than expected, all those hopes for U.S. rate cuts just vanish.
Right.
And the impact of that is instant. It hits the yen, weakening it further, and it hits the Nikkei, likely pushing it down as global risk appetite shrinks. Wednesday is going to be a highly volatile session depending on that one print.
Moving to Thursday, March 12th. Domestically, we have Japan's BSI business conditions and Tokyo condominium sales. From the U.S., the February PPI, the Producer Price Index, and retail sales. Oh, and India's CPI is also released.
I actually want to look at the Tokyo condominium sales for a second.
Really? Among all the global macro data, why focus on local condo sales?
Because condo sales give you a real-world, tangible snapshot of Japanese consumer confidence.
Ah, yeah.
Buying a condo in Tokyo is a massive financial commitment, often tied to floating rate mortgages. If those sales plummet, it tells you that Japanese consumers are nervous. They might be expecting the Bank of Japan to hike interest rates, which would make their mortgages more expensive.
So it's a micro indicator that hints at macro expectations.
Exactly.
And on the U.S. side, for Thursday, retail sales is the one to watch, right?
For sure. It shows if the American consumer is still spending despite all this inflation. If they are, the U.S. economy is running hot. If retail sales drop, maybe the rate hikes are finally biting.
Which brings us to Friday, March 13th.
The climax of the week.
It really is. It is a massive data dump. Domestically, we have the major SKU settlement and Camille Holdings ticker 3038 reports earnings. Then from the U.S. January personal income and spending, the PCE deflator, the final Octic GDP, JOLT test job openings, and the Michigan Consumer Sentiment Index. Let's start with the domestic side. What makes this major SKU day so important?
Friday is going to be explosive, and the major SKU is a big reason why. SKU stands for Special Quotation. It happens on the second Friday of March, June, September, and December.
It's basically when a bunch of futures and options contracts expire all at once.
Exactly, and because all these institutional traders have to settle or roll over their positions at the exact same time, it creates massive volume-driven volatility.
Right, the market can swing wildly in the morning session, completely detached from any actual news.
Spot on. So you have that high volatility in Japanese stocks during the Tokyo session. And then later that evening, the U.S. releases the PCE deflator.
Now, we already talked about the CPI on Wednesday. Why is Friday's PCE deflator a big deal?
Because the PCE deflator is actually the Federal Reserve's favorite inflation gauge. The CPI gets all the media headlines, but the Fed prefers PCE because it accounts for changes in consumer behavior.
The substitution effect, like if beef gets too expensive, people buy chicken instead.
Exactly. The PCE measures what people are actually spending their money on, rather than just a fixed basket of goods. So if the PCE comes in hot on Friday, the market will absolutely react. Combine that with the JOLTS job openings data.
Which shows if the U.S. labor market is still too tight.
Right. You combine all of that, and Friday could be one of the most volatile days of the month.
It's an overwhelming amount of information to synthesize, but breaking it down day by day really helps show where the pressure points are.
It does.
So as we wrap up this deep dive into the SBI outlook, I want to ask you for a final thought, something for the listener to mull over that maybe we haven't explicitly stated yet.
Yeah, I think the most important takeaway here is a bit philosophical. We often think of domestic markets as reflecting domestic health.
Right. If Japanese companies are doing well, the Nikkei goes up.
Exactly. That's the traditional view.
Yeah.
But this week's outlook fundamentally proves that is an illusion. The Japanese economy is intrinsically tethered to the mood of the Middle East. It is tied to the spending habits of the American consumer buying retail goods. It is dictated by inflation data out of China.
We are not an island economically.
Not at all.
Huh.
In 2026, there is no such thing as a local market. If you are trading Japanese equities, you are trading global geopolitics and U.S. monetary policy. You have to keep your eyes on the entire globe, not just your own backyard.
That is a very sobering but essential perspective to keep in mind as we navigate all this volatility. Thank you for walking us through it.
My pleasure.
Thank you for watching the Japanese Economic Review. We look forward to having you with us again.